Sunday evening, you're checking Bitcoin price. It trades at $90,000. You check, few minutes later, it's now $87,000. Few minutes more, $84,000. You're wondering what the heck is going on. Are we having another exchange collapse or what? You're going through Twitter feed, you find nothing meaningful about Bitcoin news. Well, it's because this recent dip isn't about Bitcoin itself. It's not even about US stock market. It's all about Japan. Japanese debt to GDP ratio is at 236%, which is the second highest debt to GDP ratio in the world behind Sudan, a country in Africa, those of you who do not know. Unlike Sudan, Japanese economy is the one that matters, especially for foreign investors, and even more so for United States. Historically, no major economy survived with such a high level of debt without defaulting, which means they cannot pay the money back or hyperinflation, printing so much money that currency essentially becomes worthless. A good example of that is the same Sudan with the current inflation rate of 90% annually, Zimbabwe with the current inflation rate 172%, and even more so Venezuela with the current inflation rate 270%. Anyway, you might be wondering, how did Japan put themselves into this corner in the first place? 1980s, 1990s stock market and real estate bubble. After rapid growth in 1960s through 1970s, Japan entered the 1980s with a strong export and rising corporate profits. The Plaza Accord 1985 caused a yen to appreciate sharply, hurting the exports. To offset the slowdown, the Bank of Japan lowered interest rates, making the borrowing extremely cheap. Easy credit plus investors' optimism equals huge speculation in the stock market and real estate. The Nikkei 225, which is Japanese index, skyrocketed between 1985 through 1989. By December 1989, the Nikkei reached 38,900 points, more than triple in the mid-80s level. Valuations were absurd, PE ratios over 60s and 70s for some companies. Market cap of Japanese companies became more than 40% of the world's entire stock market value. That's insane. People believe Japan's companies will grow forever. Classic bubble mindset. Real estate prices grew even more extreme than stock market. Land in Tokyo's Ginza district was valued over $200,000 per square meter. The Imperial Place ground was famously said to be worth more than the entire state of California. Banks lent aggressively using real estate as collateral. It was essentially 2008 US housing bubble, but on steroids. The crash, 1990 to 1992. The Bank of Japan raised interest rates starting in 1989 to cool the speculation down. This triggered a simultaneous collapse. Stock market fell 60% in 3 years. Real estate prices began 15 years decline. Because banks had lent heavily against real estate, the crash turned into the banking crisis. The Lost Decade. I guess they should have renamed this The Lost Decades. After the bubble burst, GDP growth stagnated. In fact, Japan never was able to recover from that massive crash till this day. Now GDP is at the same level where it was back in mid-1990s. Stagnation for 30 years means economy was not growing for 30 years. Well, Japan did try to fix it by lowering interest rates to 0%, sometimes even negative, and conducting quantitative easing. When interest rates is 0% or even negative, they pay you to borrow money. Wow, what a deal. Basically getting free money. Sign me up. The Bank of Japan became the biggest buyer of their own debt, and they were doing QE. Printing money and buying their own debt, why not? There is no interest rate payment on the debt anyway. It's like you have a massive credit card debt and you print your own money to pay off the previous debt. In the real world, it doesn't work like that, but if you're a central bank, you can get away with this Ponzi for some times. Well, it's been 30 years already. The debt is irrelevant anyway. There is no interest rate payment on the debt, So what does that matter? On November 21st, 2025, the government under Saneta Kichi approved a stimulus package of $135 billion. This makes its largest Japanese fiscal stimulus since the COVID pandemic. In theory, when the market knows there will be a huge sum of freshly printed money coming into the market, it should be good for economy and for the lower interest rates, right? Right, but not in Japan. All government bond yields skyrocketed across the curve. 40-year government bond hit 16 years high, 3.7%, the highest since 2007. A 30-year government bond yield hit all-time high, 3.3%, and so on and on. Essentially, what market is saying, we have lost confidence in Japan to repay its debt. Now, since the interest rates on the debt increased in the past few years, Japan spends 24% of their tax revenue just on interest rate payment alone. Forget about government programs, forget about repaying the debt in total, there is no money for that. But what if the interest rate on Japan debt will continue to rise, and Japan will pay not 24% of their tax revenue to service the debt, but 50%, and eventually 100%. Well, if that happens, Japan will default on their debt. They will bankrupt the entire economy. Basta, no mas, finito. But there is an option number 2, that is Zimbabwe Venezuelan type option, is to keep printing money, keep this Ponzi going to remain solvent. You may think, why do I care? I do not live in Japan. Will it affect me and my investments? Well, as we know, Japan is the biggest US Treasury holder in the world. China used to be, but China has been dumping US Treasuries for many years now. Japan now is the biggest one. It owns $1.2 trillion of US Treasuries. Slowly or suddenly, Japan may become another China, as the yield on government bonds in Japan continues to rise, and soon enough it may match the yield on US Treasuries. In that case, Japanese investors do not need to invest in US, as they can just park the money into their own country and receive a competitive yield. But there is a much bigger problem than that. When the interest rates was at zero in Japan, what did investors do? They essentially borrowed billions at 0% interest rates at Japan, and they bought 30 years US Treasuries at 4.74% yield. Technically a genius arbitrage, or so it seems like an infinite money glitch. Or at least that's what they thought. But now the interest rates are rising in Japan, while the interest rates in 30-year treasuries is expected to decline. That arbitrage soon will disappear. No more easy money for Japan. Game over. So why does this matter to you once again? US is highly addicted to debt with $38 trillion last time I checked. US is paying more than $1 trillion in only interest rate payment on its debt. That is 20% of their total tax revenue. When Japan will start to unload US debt, when there will be more sellers than buyers, what will happen? Prices go down. In the bond market, when the prices go down, interest rates go up or yield goes up. When yield goes up, it creates a tighter economic conditions, and therefore it may impact stock market, Bitcoin, and other risk-on assets across the board. We have seen this before. In August 2024, Bank of Japan raised interest rates on the government bonds for the first time in 10 years. In a week, S&P 500 was down by 8%. While the Bitcoin was down by 23%, it fell from $65,000 to $50,000. Similarly, on November 30th, Japanese government bond yields just hit levels the market hasn't seen in almost 2 decades. The 10-year Japanese government bond jumped to 1.84%, the highest since 2008. The 20 years hit 2.88%, the highest since 1999. Bitcoin was down from $90,000 to $83,000. That would be 8% drop. $785 million got liquidated within few hours. This is why this reaction was sharp and broad. It was not because of Bitcoin specific event. It was a global liquidity adjustment driven by Japan. Bitcoin responds faster than any other asset to a sudden change in liquidity. Alright guys, let me know what you guys think about Japan and Bitcoin. Comment below, subscribe, and like this video.